Hey everybody, this is Jose Blasco. We are about to get started. 30 seconds to go. Can I have a quick check for the sound? It would be great to have a quick hello on the chat box. That not only would be very nice of you, but also it would be my indication so I know you hear me, and therefore we're ready to get started. I will put myself in the bottom right corner on the screen. How are you, everybody? Good to see you. Let me see, just a few seconds to go. Christian, how are you? Nice to see you. Thanks for confirming. Johnny, how are you? Very good. Perfect. Okay, everybody. So we are live. Today is January 28, 2021. We are ready to begin our session, Options with Options. I always say it, it's so true. Options give you options. So we're going to look at the markets, see what the markets have. See what the markets are doing, what's available, and therefore utilize options to adapt to those market conditions, since options give us options. So we'll be positioning ourselves in this way. And in a simplistic fashion, I would mention directional opportunities, non-directional opportunities, meaning that we could use options to make money as the market moves, either up or down. We can also use options to make money and be well exposed and manage the risk when the markets are moving sideways and still profit, even if the markets are not really moving. Okay, so we're going to be exploring all those different possibilities and see again what the market has available. Market is the boss. So if the opportunities are there, they meet our rules, we'll execute. If the opportunities are not there, or there are opportunities, but they don't meet every one of our rules, then we will pass, because as traders, we have to be disciplined, diligent, etc., etc. Okay, so before we get started, I would like to highlight the disclaimer on the upper part of the screen. Please go ahead and read it carefully. This is important information. So don't skip any word. I'm counting on you guys to read it completely. It's just a couple of paragraphs, so it's not like I'm asking too much, but please make sure you have read it every time you attend our sessions. Very good. So we are ready to go. The session is now officially introduced. I can see we are a few more in the session right now. So let's get started. Here we go. So here's the chart of the S&P and the way I'm going to conduct the session, the way we normally do, right? We're going to be looking at what's happening in the market right now. That's the first thing we're going to do. Second, we look at trades that we may have running. Let's see what's happening to those trades, so we can talk about the trade management for those trades. And then, of course, we get into the most important portion of the session, if you wish, which is when we're going to be looking at brand new opportunities and ready to execute them. Okay, so let's begin with the markets. We are looking at the S&P. Something that moves fast in one direction tends to move fast in the opposite direction, especially when it hits a wall. In this case, the UFO. So the markets were falling very hard yesterday, with around 3% down for most indices in the US. Hit those UFOs, and prices coming back up at a pretty powerful pace, 1.57% right now. That's what we have from that point of view. But let me do one thing very quick here. I just want to reload SPY, because for whatever reason it didn't load properly. Here we go. Now I have it right. So the one thing that is important for us to see, certainly we have those UFOs that created that turning point, okay? But very, very careful here, because notice what happens to the daily time frame. So the daily time frame got a change of climate, okay? The climate that was blue, even though yesterday, obviously after the 3% move down, that climate went from confirmed to unconfirmed, likely going to be a change of climate, which is indeed today confirmed. Not only we had a change of climate like we had that day, but it was not confirmed. Notice the dot was thin. Today, the dot is thick, meaning that not only the climate is down, but it is confirmed to be down. So what's the expectation? Well, based on probabilities, we would expect this market to move to the downside for 3 or 4 days at least, based on those statistical measurements, right? So careful, okay? Especially, for the long-term investors out there that you may be invested and you're like, okay, that's it, it's bouncing, it's coming back. So let's always be realistic to market data and what the methodologies and the rules suggest. And certainly it's no time to be long. Well, if you did go long, congratulations, but statistically speaking, odds are more, at least at this moment in time, odds are pointing at the market to continue going down for another 3-4 days. Okay, so careful with that. because certainly that could be the case. Okay, that's what we have when it comes to the market itself, the broad market, which I am analyzing by looking at the VIX. Okay, but what if by looking at the S&P ETF? But what if I look at the VIX? Well, if I look at the VIX, it's doing something absolutely amazing. The VIX yesterday hit almost 38, which was the values of implied volatility we saw throughout the US election. We almost went there, and from almost 38, we are now down about 28. So, for the ones of you trading yesterday, okay, if you were paying attention to this and you had run the scans, probably yesterday was a fantastic day, easy day to get plenty of beautiful high probability non-directional trades because the options prices were going to be overpriced for almost every single option available in the US markets, and selling options would be the way to go. Normally we do that in what we call credit strategies, isn't it? Which are either purely non-directional trades or what we call neutral, which neutral is a trade where we expect the stock to either go up or stay the same but not go down. A neutral short is an opportunity where we expect the stock to either go down or stay the same but not to go up. Okay, and a non-directional trade, a pure non-directional trade, is when we expect a stock to remain ranging. Okay, so yesterday all those credit opportunities were definitely available, and hopefully some of you at least were trading actively yesterday and you were able to capitalize on that. Okay, it doesn't mean that now we are late to the party and we cannot trade. It's not the case at all. Okay, actually we just got into a green UFO. Okay, so there are 58% chances for volatility to go back from 28 back up to around 32. Okay, so volatility may increase, which by the way would be to be expected as the S&P goes back down, which is what is to be expected based on the climate that we just checked on the daily time frame of the S&P. Okay, so just be ready for anything and everything. This is kind of like the mindset of traders all the time. Anything could happen anytime and we are ready for it. But it's also good to kind of plan ahead without creating a bias, okay? Because I could be wrong, right? So the market may now start making all-time high again. So I could be totally wrong. So you don't want to create a bias that avoids you taking trades that your methodology suggests you should, just because, you thought or I said or whatever. So we always need to be ready to do anything our methodologies suggest. At the same time, not to miss the trade, you have to pre-plan. Okay, and the only way to pre-plan it's to kind of anticipate a little bit what's about to happen. So at least I'm going to start getting ready on the trades, and I may click the button, I may not click the button, depending if my rules are met or not. But again, in order to be efficient with your time, this is certainly the way to do it. Okay, so anyway, we know the market is in that position where it's bouncing after yesterday's fall, but the climate is down. Options took a break, going from 38 down to 28, but we are in a green UFO, so options prices may rally again. So in that environment, to be honest, I'm ready to take anything, really. Options prices are not cheap, so selling options is definitely a good one. Options prices are not expensive because we are in a green UFO. So buying options and catching a move and riding a move, it's certainly a valid choice too, right? So we are good to go to really give a yes to any opportunity, again, that meets our rules. Now, having said all of that, you may notice that I run the scan looking for directional opportunities to go long, and I got 0 results. I did the same with the scanner for directional opportunities to go short, and I only got 2. Okay, and then with the non-directional opportunities, I only got 4, and with credit spreads, I got just a little more, but not too many. Okay, so what's going on today? Well, what's going on today is that when the markets move a lot, like for example, the markets fell very heavily, so most of the stocks are in a down climate, and that's why we got no opportunities to go long today. At least today when I run the scan. Okay, you can certainly go ahead and rerun the scan now, and new opportunities may appear. Typically, you will not have too many more because a few hours ago and now it should be similar, but it could be. Okay. So again, why is it that we don't have opportunities to go long? Well, because the market felt very heavy yesterday. So if you were long, you should have been long already for a while. No time to go long now. As the climate is down, it would be a healthier or safer bet to look for opportunities to go short. So when I look for opportunities to go short, I got 2 opportunities. So how come I got only very few? Well, the reason why I got very few, and this, to be honest, is not necessarily exactly like that, is because the information that we use, okay, for example, this company, Feye. So if I look at that stock, okay, and I'm just going to load the daily time from here, you'll see why. Because I want to turn on implied volatility stochastics to measure the prices of the options. So notice how the options for that stocks are pointing at 18.22, which is a very low value. Not only because it's 18, but just because of the process that is being run on the scanner. It's a low value, meaning the options on that particular stock are quite cheap. So it's interesting that the market was falling very hard, but that stock stays so far with options that are relatively cheap. Okay. In other words, it's a good idea to go ahead and write a move on a stock that gives you a valid setup, given the fact that options are cheap. Okay, it's going to be a good idea because when you buy options, the most you can lose is what you pay for them. So if you pay little because they are cheap, then you have little risk. Okay, plus options tend to work in a cycle where cheap options become more expensive options become cheaper. We talk about a cycle going from underpriced to overpriced to fairly priced in the middle, if you wish. And therefore, if you buy them for cheap, so that's a good beginning, right? So the scanner is giving us permission for Feye and SRPT to do that. But while the market is falling hard, there are no more stocks in that list. Why is that? Well, precisely because the market is falling very hard, probably implied that many options became too expensive to show up on the scanner. And while you could go ahead and take the trade, it's not putting you at an advantage. So you want to make sure when you buy options that they are cheap enough. Okay. Now, a minute ago, I said that the result of the scanner may not be 100% accurate in this case. Why? Well, because the scanner, when it comes to the values of options, is utilizing the implied volatility value, which is updated by TradeStation every day at the end of the day. So in other words, that value that we see here of 1822 has to do with the value at yesterday when the market closed. Okay, and when the market closed yesterday, again, if I go back to the VIX, where was the VIX? Okay, well, the VIX was 25% higher than now. It's 25% lower today. So in other words, there are many options today that are probably good to buy, but they don't show on the scanner because the scanner is utilizing yesterday closed data. And unfortunately, there is no way I can do to change that. Okay, so the only way to change that would be to do an analysis manually. And again, if we were to have time, I'm happy to do it. But hopefully we'll have opportunities enough and we don't need to do much manually. Okay, so again, just going through the process, guys, because the intention behind the sessions that we run is that you guys, through practice and through observation, little by little, you become independent. You know how to do the process. To do that, you have to practice by yourself. And as you are doing this by yourself, you may be like, how come today I only got 2, right? And when these things happen to you, again, I like to share a little bit of the insight, if you wish. So when that happens to you, you understand why it's happening, okay? Now, non-directional trades. Why is it that we only have 4? Well, because of the opposite. Options are very, very expensive across the board, at least if you look at the value at yesterday close, where the VIX was 30 plus. But what happens? The market moved 3%. So what is our scanner looking for when we look for non-directional opportunities? Where the scanner is looking for quiet markets where betting on not much happening is a safe bet. But what happens when a big move happens? Well, then that distorts probabilities. And next thing you know, the market starts impulsing. And next thing you know, a stock that was quiet may start moving. So now you don't have as many odds anymore to be on this trade. So while many, many options are expensive today, well, few stocks are quiet. And that's why we got only 4 symbols in the list. So again, every time we do a session, we have a different story. Sometimes, and this is a comment for the ones of you that are newer to the sessions, you will see that sometimes we run a session and we have so many stocks to do for non-directional trades. Sometimes very few, sometimes plenty of stocks to do directional, sometimes very few, sometimes lots of everything, sometimes little of everything. So again, we adapt to what the market has to offer, which each day is different, and I'm just describing it. So when you do it by yourself, you understand why things happen the way they happen, instead of, oh my God, why is it like that? And you kind of lose confidence, and then you don't trade, or you don't know what to do, or things like that. Okay. Anyway, hopefully this makes sense. It'll be lovely to get a bit of feedback from you on the chat box in this initial part of the session. So before we start looking for opportunities, there is a trade here, which is UPS, which is a trade that we planned some time ago, and I wanted to review. This is a trade that very, very, very few of you would be able to execute. I remember last week, I don't know if you are with us today, Mark, but I remember Mark last week commenting on the chat box that he was not able to get the premium required on the trade. So maybe someone got it. I would guess that the majority of you didn't, or if you tried the next day, maybe yes. But in any case, I wanted to show the end of the story, even though this is a trade that I personally was not executed, that we were counting on that stock to end up last Friday, which is the vertical line pointing at January 22nd. We were counting on that stock to end up inside the purple area, and it did. So, it teased us for a little bit. Okay, it did it again here with a little wick coming out of the purple area. But in the end, it did close inside, and this trade, it was an iron condor. It was a profitable iron condor. And if you did execute the trade, then congratulations. If you did it on paper money, hopefully it was a good experience, especially to see how you reacted when you saw the market going against you. And, would probably be a good exercise for the management of your emotions. Okay. In any case, again, not too positive that many of you got the trade, probably, just a very few of you, maybe no one. So I'm just going to get rid of it. That's it. That's all we had to be reviewed, given the trades that we executed last week, which I remember last week was not too active, isn't it? And therefore, I'm going to continue now with the session looking for trading opportunities. Okay, so let's begin with the non-directional trades. Since the premium is quite high, maybe it's a good place where to start. And I'm going to start with UPS, actually, which is that one. And that actually is going to be very easy and a short one. Earnings are happening on the 2nd of February. Okay, earnings are happening on the 2nd of February, as you can see here. So being this the case, okay, if you look at 2nd of February is right there. Well, the only way to do this trade would be to use tomorrow expiration. Okay, we could try. Okay, we could try. I don't think it would work, but we could always try. And if not, we will need to use February 5 expiration, but that will not be allowed based on the rules because earnings would take place prior to this date, which is February 2nd. Okay, so in this sense, the only way to do this trade would be to use the 29th of February, and I'm going to be pragmatic. Okay, I'm just going to delete everything we got on the screen here, and I'm just going to leave one line, and I'm just going to place it where the furthest second UFO is, which is this one. Okay, so UFO number 1, UFO number 2, this is the furthest one. Because 2 UFOs below, it's closer to the current price, isn't it? So I'm just looking at the furthest UFO, counting 2 UFOs at a time, because the rules say that we need to have at least 2 UFOs. That's 164, and with that number in mind, let's call it 165. I'm just going to go ahead and turn on OptionStation Pro, and go ahead and look at how much I get paid if I sell the 165 call. Probably it's going to be too little. Okay, it's not going to meet our 35 cents rule, and if it does not meet our 35 cents rule, then that's it. We're done. The trade is over, and we're going to have to go for the next symbol. Okay, but if it does, then we'll continue working on that, which I would be surprised, but it's always good to check just in case. So 165, how much we get paid? Well, we get paid 10 cents, which is less than 35. So end of the story. If this number had been 35 or more, then it means that we still have very decent levels of premium for an option that expires tomorrow and it is so far away from the current price. So it would certainly be very, very nice to go ahead and plan the Iron Condor using those UFOs. But as I just said, we got very little premium. 10 cents is way less than 35. So no need to spend time with UPS, and therefore we move to Apple, which is the next stock on the list. Okay. Now with Apple, I got a concern. Okay. First concern is that there is no data. Let me see what's just happening here. I'm not sure why this is happening. This happened the other day. Give me 1 second, guys. I want to fix this little problem. I'll fix it very, very quickly. Almost there. Here we go. Should be fixed. Let me see. Yes, perfect. So the problem I was mentioning when it comes to Apple is that at least on TradeStation we don't have options data information available. Okay, and that is a problem because you cannot take a trade and be blind. So again, we can always go ahead and turn EPS postings on TradeStation, and that will give us these dots on the chart, okay, pointing at when the prior earnings took place, where you can see it was right here in November. So if you do the math from November, you add 3 months, and it may be about February. So earnings may be about to happen, and it's funny that we don't see it. Okay, maybe earnings just happen, and that's why we don't see it. But at the same time, we should have an orange dot here, and it's not. So it's either somewhere information is delayed, or something is happening somewhere, or something somewhere, or somewhere something. In other words, we cannot trade like that, isn't it? I need something more concrete for me to know. And in this sense, I am loading. Give me 1 second, guys. I am loading TradingView on my other computer screen. Here we go. I'll bring it here. That way, we can go ahead and load Apple and check that information from another source and see what's going to happen. So notice that the last time we got earnings was on the 27th of January. Okay, so that was 2 days ago. Okay, so it's interesting how this took place 2 days ago, and actually the next date for earnings are showing up here as 4th of May. Okay, so earnings already took place, but TradeStation, it's not reporting any of this. Okay, TradeStation is not reporting any of this. So it's weird, but 2 days ago, I'll take it. Okay, I will take it. Actually, wait a minute. It's not 2 days ago. It was yesterday. It's 2 days ago for me because I'm in Asia. But being in the US, it's yesterday. Today is the 28th. For me, it's the 29th already. So yeah, so it's 1 day ago, and that's the reason why it's not updated here in TradeStation. Okay, so yeah, so we're gonna have to look at something else before we get excited here, because remember what I said earlier, that TradeStation updates the information related to implied volatility at the end of the prior day. So if I look at implied volatility stochastics for Apple, should be quite high. It's 53.75. Okay, that was, you know, with the earnings out there. But if I look at the option chain and I look at Apple, now I'm going to get to see the real-time value for implied volatility. Okay, and that may be very similar or different. So what do we have? We have 48%, 48.45, which is less than 53. Okay, but 48 is still very high if you think about it compared to 53, especially given the fact that the VIX dropped by 25%. Well, you know, I would say it's pretty high to see the volatility of Apple still at levels which are almost the same levels we had prior to earnings. So I was almost going to discard Apple, because if we were basing the implied volatility based on yesterday, and yesterday was the drop of the market and the earnings report, but today there was no drop and there was no earnings report, so I was expecting that value of 53.75 to potentially could be way lower, maybe 20, right? And if that was the case, you think you're selling options with 53 implied volatility, where their volatility is about 20. That's crazy. It would be way less premium than expected. And I was going to discard the trade. But since we can still see on the option chain implied volatility levels of 48, I'm going to say, let's continue. And I don't know if we have a trade or not. Okay, maybe not. But I'm going to go ahead and continue planning the trade, because we may have an opportunity here on Apple. Okay. Good. So now, what else do we need for an opportunity to work in that sense? Well, we need at least 48%. We got 49, so that's okay. What about pre and post market? So if I move to pre-post market, 49 becomes 52, which is even better. So all of this is good, but my issue is not red UFOs if I look at the pre and post market, and if I look at regular session, one red UFO only, where the rule is telling us you need at least two. So is it because there is more data? Well, if you look at the monthly time frame of Apple, you will notice that that stock is making all times high. I guess if you have been trading for a while, everybody knows that, and therefore there is no more data. Okay, whatever is available is what you see. So that's a problem. Okay, why? Because if we were to do an Iron Condor of Apple, we are breaking the rules because we do have two UFOs below, but we only have one UFO above, and that is not how we plan on an Iron Condor. So what can you do? Well, I'm just looking at the time. We still have 20 minutes left before the session is over. So what can we do? Well, I'm pretty positive that in that situation, we should be able to find Apple in the neutral section. And here we go. Here's Apple. Okay. So in other words, we could do a credit spread on Apple, and instead of selling the calls and the put side, sell only the put side, do half of an Iron Condor, which is a credit spread. Okay. And I'm oversimplifying what is a credit spread or what is an Iron Condor, but I guess it's a valid way to say it in a simplistic way. Okay. So we could certainly go ahead and explore that. Another way to explore that, given the fact that premiums are high and everything else, it's to go ahead and put together an intelligent combination like what we did prior to US election with Intel, where we sold options to buy options in exchange and do a free trade. Now, this was not an active trade, that was a long-term investment. And again, Apple is one of those companies that I would say is not likely going to go bankrupt anytime soon. It's not a company that pays that much dividends. But again, as a stock trader, maybe you would be happy to own some shares of Apple. So, there is a technique that we could exploit later on how to do that intelligently. Okay, but in the meantime, I would like to go back to non-directional and complete the list of symbols just in case we do have an Iron Condor available, and therefore complete what I was doing. So then we got NVAX, and here first is a bad news. We got 46%. The minimum we need is 48. So then I'm gonna go check pre-post market to see what we got, and we got 49. So that's good. Okay, now only one UFO above. So is it because that stock is making all times high? Again, this is a stock which is not as well known as Apple. And when you switch to the monthly time frame, well, notice that actually there is plenty of data starting here on 2015. Okay, 2015. So yeah, we need to load a lot of data here, all the way from June 15. Okay, so certainly worth it to be done. But before I do it, I would like to go ahead and look at the liquidity of those options, because this is going to be a process. If I need to load data all the way from 2015, it's going to take a while. So first, I'm just going to check the options. And if the options are liquid enough, then I'll get excited to do that. And if the options are not that liquid, then I will go for another stock. Okay, and options are not really liquid, too much spread. So what if I look at the monthlies, which are normally more liquid? 1921 still, $2 of spread. Yeah, there is not enough liquidity on that stock to do the trade. I mean, you could do it and close your eyes, but that doesn't add odds in your favor. So I'm not going to bother and load data all the way to 2015, given the fact that I would not be happy trading those options out of liquidity, okay? And then IFF, okay? So notice that we got 44% probability. We are also, that's not good. Obviously, it's less than 48. And if I switch to regular data, I got 52. So that's good. Okay. But, we don't really see green UFOs. Okay. So why is that? There's plenty of market data there. Okay. So I may have to load data all the way from March. Okay. So that may work. But again, I'm going to check. I'll be with you in just a second, Christian. check liquidity with IFF, and it's absolutely terrible, 1.5 to 570. You would get killed on slippage. If I look at the monthlies, 3.70 to 8.5 is absolutely ridiculous. So again, no need to worry and bother on loading data. Again, plenty of volatility built in for different reasons. And I agree with you, Christian. The expected vaccine, all of those things are built in, and it is reflected on the prices of the options, as well as how much market makers are ready to take advantage of the public or the non-educated traders that may buy those options just using a market order and suffer the whole spread in one trade. Okay, so again, we don't want to be trapped of any of that, and therefore it's not an ideal scenario for us to do those trades. Okay, so I'm going to move into neutral opportunities. I guess that going to Apple will be the right thing to do, to look at the opportunity from a point of view of credit spread, but also the long-term investment opportunity I was discussing. Before I do that, I want to give a little bit of an extended answer to Christian when it comes to, is the vaccine an opportunity, yes or no? And the answer is it's a gamble. That's the answer. Okay, it's just like throughout US election, throughout any major event, is it an opportunity? Yes. But could statistics or anything we do really help you on understanding the outcome of it? No, because those are opportunities based on fundamental factors which are not measurable in any way, because when was the last time that there was a pandemic worldwide, right? So we don't have fresh data, and even when it happened, it didn't happen repeatedly, and the data we collected when it happened in, I think it was in the beginning of the last century with the Spanish flu. So we don't have data which is properly collected. So again, we got nothing. Plus, even if we have the data, markets were not electronic at that time. So again, is it an opportunity? Yes. Will there be people out there that will position themselves either long or short or whatever, and they will profit from it? Yes. Now, are those going to be lucky people? Yes, because there is no way to have a quantifiable edge which is significant in any way. Okay, unless you have some insider information or something like that, which is not my case. Okay, so therefore, what can you do? Okay, what can you do? Well, what you could do, Christian, which is what we did throughout the US election, is you could use options to create positions that have a very large buffer that allows you to be wrong without pain, in exchange for instant profits if you're right on your gamble. So if you're right, you profit immediately. And if you're wrong, you need to be wrong in a major way for you to end up losing. Okay, we could end up with positions like that, and therefore you're still executing a gamble, if you wish, but you do it in a way that is very, very smart, and certainly it's a valid way to approach it. Okay, but for that you need options, and the problem that we saw is that NVAX does not have liquid options, and therefore what I'm about to demonstrate on Apple will be probably impossible to replicate on NVAX. So maybe you did it with Pfizer a few months ago, and it was a beautiful way to do it, or any other company that benefited from the pandemic. It doesn't need to be drug companies. It could be Netflix. It could be Zoom. Many technology companies benefited from it, even some supermarkets and food companies, and again, there are all sorts of businesses that benefited from the pandemic while others suffered. So you could certainly replicate this action with other opportunities. Okay, but you need liquid options, and NVAX unfortunately does not provide such quality. Okay, so I'm gonna get into Apple and look at the credit spread and look at this other opportunity. And this will take us to the end of the session, and hopefully that will be helpful for you, Christian, and everyone. I'll take a sip of water if you guys don't mind. Thank you very much. Johnson & Johnson is working. Very good. Wonderful. Love to hear it. Thank you, Christian. Thank you, my friend, and appreciated you sharing with the group, as well as being engaged and your level of commitment, and being there, always watching the sessions and learning and applying it on your spare time, and adding time and effort. Okay, that I love to see. Very good. So Apple. Okay, so what can we do with Apple? okay, if we only have green UFOs and we don't have enough of the red UFOs, where we could do a credit spread. And how could you do that? Okay, well, Apple is very liquid, so we could start using the next expiration date, which is 8 days from now. And what I do is, I don't even think, I just right-click anywhere to analyze and sell a vertical. So analyze and sell a vertical, I got my TradeStation set up where it calculates for me -1 standard deviation above and below price. And because we only have green UFOs, I only care about the below price, not the above. And therefore, it says that from now until February 5, statistics suggest, the implied volatility built in the options suggest, and the pricing model, that in a 68.4% of the cases, which is 1 standard deviation, the price of Apple would drop maximum to 129.47. Okay, so 129. So in other words, let me draw a line on the chart at style at 129, somewhere here. Okay, so in other words, from now until February 5, statistics suggest that Apple should not be below 129. So if we apply to this our rule of 2 UFOs, and I was to draw a line below the second UFO, beyond the dotted line, that's 126, and that tells me that if I was to sell options, okay, if I was to go ahead and do a credit spread made up selling the 126 put and buy a put below, let's say the 125, assuming those strikes exist, which I need to check, which I'm positive they will, but I need to double check. So I would be selling the 126, get paid premium. I would buy the 125, pay premium. The net differential between the two would be a positive credit for me, meaning I get paid. And then as long as Apple stays above 126 from now until February 25, then I make money. Okay, so this is a non-directional opportunity. It belongs to the neutral territory, because if it stays the same, drops a bit, or go higher, you profit no matter what. Now, if it really drop, okay, if it really drop and drops and drops and drops and keeps dropping, then of course you're gonna lose, and the amount of money you lose is the difference between strikes. Okay, so you have risk and reward under control. There is no use of stops, and this is a pretty relaxed way on how to trade, because you sell the spread and you just wait until February 5. Okay. Now, would this trade be allowed? From a statistical point of view and odds, it makes sense, but would it be allowed? Well, let's look at the 126 strike and let's see how much we get paid. Remember, we need to get paid at least 35 cents. Here we go. We have 36. So it makes sense to continue. I'm not sure we're going to have a go ahead, but it makes sense to continue in the process of finding out if the trade is approved or not. So I'm going to sell the 126, and I'm going to buy the 125. Okay, so sell -1, buy +1, -126, -25. So what happens if I do this trade? I get paid 7 cents. That would be the credit to be collected. 7 cents times 100 is $7. I guess that, we don't need to continue, isn't it? That minus the commissions is not going to be worth it. But anyway, for you to understand the process, you would then now look at the difference between strikes, which is 1. Right? This is what we call the roll risk. And what do we want to accomplish? We want to collect at least 15% of your roll risk in premium. So how much is 15% of 1? Is 15 cents. So if I was to be paid 15 cents, I'd be open to do the trade. But how much we get paid? Half, 7 cents. So in other words, it's not enough. And why is not enough? Well, probably because we're using an expiration date which is too close. So what do we do? Let's do the same using February 12 and see what happens. Okay. Now, when I do February 12, of course, there is a big difference, because now my statistics are going to be recalculated. And now it says it could drop to 126 something. So 126 something. Did I say 126 something? Yes. So 126 something is here. Somewhere here. So what does that mean? It means that, I can still use that line, which is 126.27, which is below 126 something. I still got my 2 UFOs, and my second UFO is still beyond the dotted line. So the trade is still valid, okay? But it's kind of like borderline, like very, very tight, okay? Okay, but it's still valid. So let's take a look, okay? How much I get paid if I sell the 126 in February 12? Well, I get paid 90 cents. Okay, I get paid 90 cents. Is that more than 35? Yes. Okay, so let's analyze it. So how much premium you would get if you sell the 126 for 90 and buy the 125 in exchange? Well, you would get paid 13 cents. Is this a trade to be accepted? No. Why? Because the parameters are exactly the same. My raw risk is 1. I want to collect 15%. 15% of 1 is 15 cents. But how much I get paid? I get paid 13. It's almost there. Almost. But it's not enough. So we don't break the rules. So what do you do? Well, we're going to have to go for February 19. Okay, and see what's going to happen now. So if I move to February 19, okay, of course, probabilities now are suggesting that price may drop all the way to 125. So what am I going to do? Move my line to 125, somewhere here, and then look for a UFO beyond. In this case, that would be 3 UFOs below. Again, it's 2 or more, and the last UFO has to be beyond the dotted line. So that's 123.49, okay? And therefore, we need to be looking at selling the 123 and buying the 122. Okay, so let's see what's going to happen, because good news, we're going to get more premium because it's a further expiration date. But bad news, because we move down from 126 to 123, the trade may still not work. Okay, and this is the game you need to be playing until you find your edge. Okay, so let's take a look at how much we get paid if we do the 123, and notice it's 92. Okay, now 92 minus 80 is going to be 12 cents. So again, 12 cents is less than 15. Okay, so it's not going to work. Okay, it's not going to work. Now, something I have not done earlier, okay, and I want to do it now. So let me show you another variation, looking for the right combination to get an approved setup. 19, 12, here we go. So notice on the top, I got the plan with a 12 using 126, 125. And below, I got the plan with a 19 using 123, 122. So those are the two plans, okay? The one before paid me 13, the one now pays me 11. So none of them are approved because none of them pay me the 15 I need, okay? But something you could do, apart from looking to go further out using further expiration dates and hopefully have the trade work, the other thing you could do is also widen the strikes. So instead of 126, you can do 126, 124, okay? And sometimes this will work, or 123, 121. So now, what is your risk? Didn't work in this case. So what's your risk? Now your risk is $2. How much you want? 15%. How much is that? 30 cents. Okay. How much you get? 24 and 21. Still not enough. Okay. So it doesn't work. But again, the idea would be that you keep playing with either going away, going further out with the expiration dates, and therefore your dotted line keeps dropping on the chart, and you keep going looking for where the UFOs are and get strikes beyond that and see if you get your rules being met and get that 15% premium. And the moment you get a green light, then you take the trade. Sometimes you may not find the right combination. So then what the other thing you could do as well is, as I just demonstrated, you could play with not changing the expiration date, but widening the spread a little bit. Of course, if you widen the spread, instead of a distance of 1, you have a distance of 2. So 15% of 2 is more than 15% of 1. So you need to make sure that the premium is going to be enough. When you widen the spread, the premium will always be more. But it doesn't mean it meets your 15%, right? Like in this particular case, it doesn't, okay? So it doesn't seem that we are finding an easy credit spread on Apple. But again, that's the process for you to follow. The other thing to keep in mind with those credit spreads is that if you look at Apple is falling, nicely today, 2.32%. So, I would expect that if, let me zoom in. I would expect that if Apple was to go below this low, it's going to start making lower prices for the day. So we may have an additional extra push to the downside, and we may drop another 1% or so. And if that's the case, okay, you'll still be okay with your probabilities, but now you'll get your 15 or 30 cents. So watch it, because later in the day, you may get it, okay? In any case, in my case, I will just leave it alone, because we are about to reach we are 1 minute away from the theoretical ending time of the session, and I want to show the other application, so you guys can think about it and look into applying it. I wanted to show the other application that could be useful to get exposed to Apple in a different way, okay? So for that, I'm going to look at March 19, 50 days out, okay? 50 days out. And again, I'm just going to apply the same rationale, okay? So if I look at March 19, okay, March 19, let me remove everything. The only reason why I'm going to leave this is to be able to do my statistical calculation. So March 19, okay, and I'm going to pick current price is 140, so anything, 135, 130, for example. It doesn't matter really. The only reason why I want to have this in is so, and I need to check market, is so I get a statistical value that suggests how far price may go from now until March 19, okay? And it's 119, okay? Funnily enough, it's all 19. So what is 119? 119 is more or less here, okay? It's more or less here. And what I'm going to do now is, instead of working on the 55-minute time frame, I'm just going to go ahead and look at what's the weekly, okay? And on the weekly time frame, there is nothing at this price point, okay? So that's not a very good thing. There is plenty of on-field orders higher, but not at this price point. If I look at the monthly, remember, I'm looking at something for investors here, okay? So monthly, there is nothing. And if I look at the daily, there is nothing at this price point, but there is right above and there is right below, okay? So the right above doesn't help me really, but the one below does, okay? So at least I feel good to know that relatively close there is another UFO, okay? So why is that important for me? Well, because knowing that from now until this date, a normal, I was going to say a normal thing to happen, but really, a normal thing to happen would be not to go below 119, meaning that something not so normal to happen is to go below 119, right? So if you were to calculate the difference between the current price to 119, okay, and I want to calculate that in percentage. Percent change. So that is a 15% drop. Okay. So knowing that there is a UFO here, I'm going to point at this UFO, and this is almost like a 20% drop. So my question to you is, if Apple was to drop 20%, would you like to buy shares as an investor? Okay. And let's say you say yes. And by the way, that's critical. You need to be open to buy shares at 110. If you are not happy to buy shares at 110, forget about it. This is not an application for you, okay? So the question is, if Apple drops 20%, would you like to buy shares? Let's say the answer is yes. So what would you do? Well, you would go ahead and explore what happens if you sell 2 times the 110 put, okay? And then we're going to buy something below, okay? And then we're going to buy something above, okay? So basically, we're going to sell those options and then buy something above and below thanks to the premium received. The downside, which is not if you're an investor, is that because I sell those options, if Apple goes below 110, I'm going to have to purchase shares of Apple, which again, if you want to own them, it's fine. That's why I insisted earlier, this is only if you want to own shares of Apple at a price which is 20% lower in case Apple drops by 20%. So how much you get paid for the 110 if you were to sell the 110? You get paid 86. Okay, you get paid 86. And just out of liquidity, I'm going to focus on the 105. Okay, so if I do 110, 105, let me write it down. So if I sell 2 of the 110 and I buy 2 of the 105, I am basically creating 2 credit spreads. Okay, the 110 pays me how much I said. I think it was 87. So we got 87 and we got 60. Okay, so 87 and 60. So this is 87 and this is 60. Okay, so I do it twice. Okay, and therefore I collect 87. I have to pay 60. So I got a net credit of 27 cents, and I do this twice. So that's 54 cents of credit. Okay, so 54 cents of credit. So what can I do with a credit? Okay, well, there is something else to buy here above, right? So what am I going to do? I'm going to go ahead and find calls I could buy for 54. In this case, the 195 cost 52. So what can I do? Did I say 195? Yes. So the 195. So what can I do? I could buy one of the 95 calls that cost me 52, and therefore I would pay 52 and get paid 54. So I could do this trade for 2 cents of credit. Let's call it free. Okay. Now, if I do this trade for free, what did I just got in my hands? That's question number one. And question number two was my risk. Okay, so let me go ahead and create a custom strategy here, because this is obviously all custom. So I'm buying one call, selling 2 puts, and buying 2 puts below. So the one above is a put and is the 195. Below we are doing the 110, and below that the 105. Okay, so sell the 110, buy the 105, and all the way above buy the 195. If you do this, it's not an amazing trade in the sense that you get a delta of 9, let's call it 10. So if the stock starts moving up, you start making money at a slow rate. Now, of course, as the stock goes higher, of course, delta will increase. Okay, 19. So again, if Apple goes ahead and picks up speed and starts going higher, and it doesn't even need to go to 195. If Apple goes up to, let's say, 150, okay, you will start, making some money. Okay, now not too much. Around 150, you will make $110. Okay, it's not a lot of money. Why? Because the initial amount of delta is very limited. Okay, is not that much. Okay, so it seems that the value of premiums in Apple are shrinking throughout the day. It's looking like that, at least based on the simulation. Okay. Again, you could try that with other stocks as well. Okay, the process will be the same. Of course, the more the delta you get, the better, right? Because the faster you will get paid as the stock goes up. But what's the point? Well, the point is that by doing this strategy, okay, now 2 things may happen. From here, the stock goes higher. So then the more it goes, the more you profit. If it goes to 150, you make 110. Okay, if it keeps going, you keep making money, and it's unlimited. The amount of money you can make is unlimited. Okay, so if the stock breaks out, never went down, you profit immediately, and the trade didn't cost you a thing, so it's nice. Now, what if the stock falls? If the stock falls, as the stock is somewhere in between here, and you look at your P&L, you will see a loss. But it's a virtual loss. Why is it a virtual loss? Well, because if you wait until the expiration date, this trade cost you, actually, this trade paid you 2 cents. So if you wait all the way to expiration date, even if the stock went all the way to here, which is almost 20% down, you will actually make 2 cents. So it dropped 20%, you didn't lose, you make 2 cents. Okay, so that's case number 2. Case number 1, what if it goes up? Case number 2, what if it goes down 20% or less? Case number 3, what if it drops 20% or more? Well, if it drops 20% or more, you get the stock at 110 because you sold options, so it's put to you at 110. Now, if it's put to you at 110 and it went down so far and then came back up, you're back in business. But what if it never came back up? Okay, which probably that's what will happen. Well, the good news is that the much you can lose is limited by the option you got below, which is the 105. Okay, which is the 105. So what's the most you can lose? Well, basically it's the distance between strikes, which is 5, therefore it's 500, but because it's 2, okay, so 500 times 2, that's your risk. Okay, so the most you can lose is $1,000, and the most you can profit is unlimited, but it depends on how far the stock goes, and the loss does not begin unless Apple drops 20% or more. So you have a nice buffer there that allows you to be wrong. This is how you could absorb, the problems associated to a gamble using the terminology I was using before, like for example the vaccine. You could afford that stock to go against you by 20% and it's still okay. Even though this setup is not ideal, again, there are other stocks with better premiums to do this, so you get more deltas and therefore pays better. But certainly, you can see the three basic outcomes. I want to mention one more thing before we go. Sorry, guys. Sorry. I want to mention one more thing before we go, which is the key reason why I said it's critical that you want to own that stock. Because if you are willing to own that stock, this is so much better. Look at this. So let's say, again, I'm going to re-summarize it one more time. If the stock goes up, you profit immediately, and it's unlimited depending on how far it goes from now until March 19, 2021. If the stock drops, okay, if it's less than 20%, you make 2 cents from now until March 19. If the stock drops a lot, then you lose, and the most you can lose is 1,000. Okay, those are the 3 setups I discussed, which are the basic ones. But what's another possibility? Well, another possibility is that there is a moment in time where you get the stock put to you. Okay, so what can you do? Well, if Apple falls sharp, aggressive, and you are very close to March expiration, and the 110 is put to you, if you really want Apple, and you want to keep it because you believe in the company, it pays dividends, things like that, you just go ahead and you close the 105 put for a pretty nice profit, okay? And you keep the shares. And then what you could do is you could do cover calls against the shares to collect more premium against, just to offset more of the problem. But again, as a long-term investor, now you put Apple at a pretty good price in your portfolio, even though it went against you, since you collected a profit from the put, and you bought Apple at a price which is 20% lower what it was the day you did the trade. So you save yourself 20% pain, you made a profit on the put, you own an instrument you believe in, and now you can do cover calls against it to offset the problem and either remove more of the pain and end up with a very limited loss, or end up enjoying profits as Apple recovers and goes back to profitability. Okay, so again, this is not a short-term option strategy or approach. This is a long-term approach for longer-term investors, or for cases that may happen quickly. When you have a sharp move, if a company releases a vaccine and next thing you know the stock gains 40% increase in price in one day, right? These things could happen. So then it wasn't going to be a long trade, but you happen to close it in one day because the move is humongous, right? But again, the initial portion, the initial thinking behind all of this is that you were happy getting delivery of that stock at that price, in this case 20% lower. If you were not happy with delivery of shares, please do not do that, because this is the recipe to be very, very frustrated if it goes against you, because instead of owning shares of Apple, collected a credit, made a profit on the put, and now start doing cover calls, next thing you know, you end up a $1,000 loss. And it took from now until March, so it was very inefficient because you tried to make a long-term strategy to be something for short-term with hope in the equation. Okay, so no hope. This is a strategy. I'll repeat it one last time and we'll call it a day. This is a strategy for when you truly want to acquire shares of a company. You just want to make sure that if that's the case, because buying shares is expensive because you need to pay for the shares, so you just want to make sure you do it at a much, much lower price. But of course, if you want to buy at a much lower price, you may miss the trade. So you apply this fancy strategy. So if it moves, you start being paid immediately. And if it drops, then you get the stock put to you at this very advantageous price, while the risk is limited thanks to the 105 put in this particular setup. Okay. Anyway, lots of information as always. I do not talk slow. Hopefully you guys are okay. Hopefully this was a session that brought in um, good good stuff, good value, good ideas for you to experience and practice and learn. Christian, can one ignore the EMA rule if there is a one UFO on the chart and the UFO does not envelop the EMA value? I mean, in a perfect world, it all depends on your trading plan, and if your long-term trading rules are the same as the short-term trading rules. In a perfect world, the sky, the stars, the moon, everything is lining up amazingly well. For sure, that would give you an advantage, Christian. Why am I, not being as strict as always with my comment here? Normally, you would expect me to say, of course, you don't break the rules. Well, the reason why I'm being less strict is because everything you do with larger time frames imply setups that happen less often. So the more demanding you are with a setup, and the less often they happen, the less active you're going to be, which is okay for long-term investors because you want to be less active. But maybe you end up, taking 2 trades a year if you have too many demands in your set of rules. Okay, so for a long-term investor that does want to acquire shares of a particular company, it would be okay to just use the UFOs and nothing else, at least in my mind, or at least the way I do it. If you are more conservative, or you already have a portfolio with many more shares and you just want to be picky, so certainly adding the rule of the EMA would make the trade to be even better. Okay, but very good question. Appreciate it. Hopefully it's all clear. Love the Apple trade. Very good. Wonderful, guys. My pleasure as always to be here for you guys. I extended the session by 15 minutes extra, which is not so respectful to the use of your time. Hopefully you're okay. I guess that some of you had to leave probably, but it's okay. In any case, I just wanted to give you those 2 different views, and hopefully it helps. You guys take care. See you soon. See you in the next one. Have a good day, my friends. Take care and be safe. Bye-bye, everybody.